Well, Motilal Oswal puts out an exhaustive set of expectations as we enter any earnings season, and they've got one of the largest universe of stocks under coverage. Gautam Duggad is head of research, institutional equities at Motilal Oswal Financial Services. Gautam, good morning. Good to have you with us here. Thanks for joining in. So, actually, two questions. How have you changed as you were building penciling these expectations in? How has the conflict affected those projections? That is one. And second is, some of this impact of what we're seeing now is going to come in the future, not in these results, at least not fully. So how does one account for that? Gautam, go on.
Hi, Prashant. Good morning. Thanks for having me here. This is an evolving situation. So whatever numbers we discuss, in a quarter's time or a month's time, those numbers can change on either side. So as we speak, our team, when they did the estimates for this quarter as well as next quarter, there's definitely an impact which is coming in. This quarter's numbers, we are expecting a growth of about 10% for our coverage universe and 6% for Nifty. These numbers, when the third quarter ended, our expectations for the fourth quarter earnings growth was 14%. More importantly, the numbers have been cut pretty sharply for FY26 as well. While at the aggregate, it doesn't reflect because there are counterbalancing forces, specifically in bigger benchmarks like Nifty. So if you look at the Nifty picture, we've got estimates by about 2% for FY26. Please understand this 2% is coming in for just one quarter's numbers because 9-month numbers were already delivered, right? And next 2 years numbers have been cut by about 1.5% each. Nifty gives a very misleading picture actually in such situation because in Nifty, only 30% of the profit pool gets directly impacted by higher commodity prices, right? You have consumer auto, consumer durables, cement, and to an extent pharma. Otherwise, metals, oil and gas actually benefits. And then you have banks, utilities, telecom, which doesn't get directly impacted in the immediate term. So the right way to look at numbers changes is to look at broader markets. When I look at our coverage universe of close to 366 stocks, and then I see the spread of the earnings, we've seen a cut of about 6% for FY27 for both mid caps as well as small caps, right? The large cap earnings cut is limited to about 1.5%. So that aggregates to closer to 3% earnings cut for FY27 for our broader coverage universe. 136 companies in our coverage universe have seen earnings cut of more than 3%. And there are only 25 companies which have seen an upgrade of more than 3%. So that tells you which way the dice is tilted. And even now, I think the expectations are still slightly elevated because analysts are still baking in the impact for the first quarter or first half. And if this situation lasts for another 30-40 days, you will see next round of earnings cut going through as the earnings season begins. And corporate starts providing commentary for April and May, because there are a lot of second, third order impacts which we are still not clear.
You said mid-cap and small-cap earnings for FY27 have been brought down by 6-7%?
Yes.
Okay. Do you want to tell us which particular sectors have seen the biggest cuts so far? And what is the potential downside risk from here on? You said the risk is that if there is a continuation in the conflict beyond, say, the month of April, it goes on till May and June, and then the second order, third order effects also come in. So elaborate a little bit more on the potential downside, the worst case scenario.
Rima, worst case is difficult to picture in. Even the best case is difficult to picture in. So we will see as things evolve. It's very futile to predict things when things are so volatile and fluid on a daily basis. As things stand, there are 3 or 4 sectors which have seen the maximum cuts. One is auto, where we have seen for our coverage universe of 27 companies, around 5% earnings cut for FY26 and around 11% for FY27. So there are many companies which have seen 15 to 20% earnings cut for FY27 because of twin impact of higher commodity prices and some impact on global demand too. And there's cement, which has seen double-digit earnings cut for FY27, close to 12%. We've seen 4 to 5% cut in many sectors like capital goods. We have seen EMS, we have seen close to 6-7% earnings cut. Even utilities has seen a pretty substantial knockdown. The only sectors which has basically bucked this is metals, which has actually seen an earnings upgrade for FY26 and FY27 both. And oil and gas has seen upgrade for FY26, while 27 has seen a massive cut because of OMCs and CGDs, even as ONGC and Reliance has provided some solace to FY27 earnings. But net, even oil and gas has seen a double-digit knock. So these 3-4 sectors have actually resulted in a disproportionate impact. On the contrary, IT has seen a 2.5% upgrade for FY27 because of currency impact, even as we've seen some cuts in FY26. So net, if you blend all of that, you're talking about a 3% earnings downgrade at a broader coverage level for our 360 plus stocks, within which mid cap is 6% and small cap is also 6% earnings cut for FY27. And as I said, at the cost of repetition, these numbers can change on either side depending on how the next 20-30 days pan out on global geopolitics and the energy situation.
Take that point entirely, Gautam, and there's a thorough analysis out here. Just thought on the Nifty valuations, where we keep talking about them being in line with average or during periods of weakness that we've seen. I'm just looking at your estimates, nearly 1,250 rupees next year as EPS. That gives you, at current levels, a Nifty of around 18.3 times. How does that compare with average? And while we do that, also be mindful of the fact that when we compare it to, say, COVID levels or earlier crisis, we didn't have a lot of these high PE stocks in the Nifty. Since then you have, say, something like an Eternal in the Nifty, you have something like a Trent in the Nifty. So those skew the overall valuations as well. If you take that off, how does that compare then?
Definitely, Mangalam, Nifty is looking far more reasonable, and it's at almost a 15% discount to long period average. The long period average is somewhere close to 20.5 times for Nifty. We are right now at about 18 times. If you go back in September 24 at the peak, Nifty was almost trading at 24 times. Even a year back in March 25, Nifty was trading at 22 times. So from 25 to 22 to now about 18 times, Nifty is looking a lot more lighter, even if you account for the uncertainty which is prevailing currently. Even mid caps and small caps, given the time and price correction that we have seen, some of the stocks have obviously seen a much bigger damage. But just look at the index level. If we take Nifty mid cap 100 and small cap 100 as representative of these two market caps, so mid cap is down from a P of 35 to now about 25. It's still at a premium to long period average, by the way. And small cap index, which had a P of 24 times in September 24 peak, is now down to close to 20 times, which again is at a premium to long period average. So clearly valuations have lightened up. Nifty is looking far more lighter and far more reasonable today, given the context of 10-12% earnings growth that we are envisaging for large cap. But mid cap and small cap may undergo some more time correction or a mix of time and price correction depending on which stock we talk about, because it is futile to talk about indices in mid and small cap. It's always more bottom-up, sector-specific for valuations.
Gautam, thank you very much for joining in. We're out of time, but it's always a pleasure to get your analysis on numbers. We'll look forward to chatting with you as the earnings season progresses.